Hello everyone! Before we start today's video, I would like you to look at this image. On the left, we see someone using an ATM. And on the right, we see someone checking information from the bank. Even though both are related to the same bank account, the information seen by the customer and the information recorded by the bank may not always be identical at a specific point of time. And this idea led us to today's topic, which is bank reconciliation. Bank reconciliation is an important accounting procedure used to compare a company's cash record with the records maintained by the bank. It helps ensure that the cash balance reported by a business is accurate and complete. Throughout this presentation, we will learn why differences occur and how accountants resolve those differences. In this presentation, we will focus on two main areas. First, we will discuss about bank statement and cash book. And second, we will learn about the bank reconciliation process. The topics are important because cash is one of the most sensitive assets in any businesses. So even small error can affect financial reporting. So of course, accountants need a reliable method to verify cash balances. Now, let's begin with the basic concept. A cash book is the company's own record of money received and money paid, meaning every receipt and payment should be recorded in the cash book. A bank statement is a record prepared by the bank showing all transactions that have passed through the bank account. So, in theory, the entries appearing in the bank statement should exactly be the same as the entries appearing in the cash book. As a result, the balance shown in the bank statement should also be the same as the balance shown in the cash book on the same date. However, in reality, differences often occur. Therefore, accountants perform bank reconciliation to identify and explain those differences. Why do differences occur? Well, there are three main reasons. The first reason is timing differences. Sometimes the company records a transaction before the bank processes it. As a result, one record contains the transaction while the other does not. The second reason is omissions. Sometimes the bank records transactions that the company has not yet entered into the cash books. Examples would include bank charges or bank interest. And finally, the final reason is errors. Mistakes made by either the company or the bank. For example, an amount may be entered incorrectly or a transaction may be processed wrongly. These three reasons explain most differences found during bank reconciliation. Now, let's look at some examples. Under timing differences, we have unpresented checks and outstanding lodgement. These are timing issues because both company and the bank know about the transaction eventually, but not at the same time. And under omissions, we have bank interest, bank charges, standing orders, direct debits, and finally, dishonored checks. These usually appear on the bank statement before they are recorded in the cash book. And finally, under errors, we have bank errors, recording errors, calculation errors, and cash errors. As an accountant, our role is to identify which category each difference belongs to before preparing the reconciliation. Now, let's understand some important terms. The first term is unpresented checks. A check is issued by a payer to settle an amount owed. However, after receiving the check, the pay may not immediately deposit it into the bank. So, as a result, the company has already recorded the payment, but the bank has not yet processed it. The second term is the outstanding lodgement. These are deposits that have already been lodged with the bank but have not yet been cleared. The company records the deposit, but it has not yet appeared on the bank statement. And the third term is the standing order. A standing order is an instruction given by the account holder to the bank to make a fix automatically on a specific date. For example, monthly office rent. Note that the third party has no power to request payment from the bank. The next term is direct debit. So many people will confuse direct debit with standing order. Now, the difference is actually who controls the payment. With a standing order, the account holder instructs the bank. With a direct debit, the account holder gives permission to another party to collect money directly from the account. Examples will include electricity bills or subscription payment. Another important term is dishonored check. This occurs when the person who issued the check does not have sufficient amount to cover of the payment. So therefore, the bank rejects the check and reserves the transaction. As a result, the expected payment is not received and the payee will need to ask for the payment again. Now, let's learn the reconciliation process. There are 3 steps. Step 1 is to identify adjustment affecting the cash book and adjustment affecting the bank statement. Step 2 is to correct or amend the cash book. And this is important because omissions and company errors must first be updated in the company's record. That's why it requires double entries. Step 3 is to adjust the bank statement for timing differences and also bank error. After these steps, both balances should agree. Let's focus on step 2. When correcting the cash book, we update items that are missing from the company's records. Examples include dishonored check, bank charges, standing orders, and direct debits. We also correct any errors in the cash book such as undercasting. After all adjustments have been made, then we will obtain the corrected cash book balance. This corrected balance is the amount that will be reported in the Statement of Financial Position or SOFP. After correcting the cash book, we will prepare the bank reconciliation statement. We begin with the balance per bank statement. Then we subtract the outstanding checks. We add outstanding lodgement. We also adjust for any bank errors if necessary, so it can be subtract or deduct. And the final balance should be equal to the corrected cash book balance. Now, let's apply the concepts we have learned throughout this video with work example 1. We are told that the cash book of Wordsworth Co. was $805.50 debit, while the bank statement shows $1,112.30 credit. Clearly, the two balances are different. Now, before we calculate anything, let us analyze the information given to us. The first item states that the cash book has been undercast by $90 on the debit side. And undercast means that the total was added incorrectly and it is too low. Since this error occurred in the company's record, it will affect the cash book. The second item tells us that there are outstanding lodgement amounting to $208.20. The company has already recorded these deposits, but the bank has not yet processed them. And therefore, this is because of timing difference. The third item tells us that there are unpresented checks, which amount to $425.35. The company has already recorded these payments, but the bank has not yet processed them. And therefore, this is a timing difference. So before we calculate anything, we can actually classify the items. So the undercast affects the cash book, while the outstanding lodgement and unpresented checks will appear in the reconciliation statement. Now, let's prepare the solution. First, we need to correct the cash book. The original cash book balance is $805.50. Since the cash book was undercast by $90, then we need to add the missing amount. This will give us a corrected cash book balance of $895.50. Next, we need to prepare the reconciliation statement. We begin with the balance per bank statement of $1,112.30. Then we add the outstanding lodgement of $208.20 because these deposits belong to the company but have not yet been processed by the bank. This increases the balance to $1,320.50. Next, we need to subtract unpresented checks of $425.35 because this payment have already been recorded by the company but not yet by the bank. Then this gives us $895.50. Do you notice that our final balance actually matches with the corrected cash book balance? Therefore, our reconciliation is correct. Let's now look at a more challenging examples. Again, before calculating, it is very important that we classify the information first. The cash book shows an overdraft of $8,970. The next item is bank charges of $550 that have not yet been entered in the cash book. Since the bank actually already knows about these charges but the company does not, therefore this item actually affects the cash book. Next, the bank credited the account with error of $425, which actually belongs to another customers. And this is clearly a bank error. We are also told that check payment totaling of $3,275 have not yet been presented. And these are unpresented checks, and therefore it is caused by timing differences. Finally, checks totaling of $5,380 have not yet been paid in at the bank. These are outstanding deposits and also because of timing differences. So we have successfully classified all items before beginning our calculation. The question is, what was the balance showed at the bank statement before taking the above items into the account? And now you guys can pause the video before we check into the solution. As always, let's start by correcting the cash book first. The cash book shows an overdraft of $8,970. Bank charges of $550 have not yet been recorded. Since bank charges actually reduce the balance, then the overdraft will increase. Therefore, the corrected cash book balance becomes an overdraft of $9,520. Next, we will move to the bank statement side. We need to remove the credit in error of $425 because it does not belong to this customer. We then consider the unpresented checks of $3,275 and the outstanding deposits of $5,380. After making all the necessary adjustments, then the bank statement balance reconciles to an overdraft of $9,520. And this actually matches the corrected cash book balance. Therefore, the correct answer is option A, with $9,520 overdrawn. And this example shows why it is important to classify the item first before we calculate anything. Thank you for staying at the end of the video. The key message to remember is that differences are normal, but accountants must identify and explain them to ensure accurate financial records. See you on the next tutorial!